All right, let's dive in. Today, we're taking a step off the beaten path. While everyone is chasing the next big thing in tech, we're going to break down a professional analyst's playbook for a company that powers something, well, a lot more fundamental, the food on our plates. Let's see what they've dug up.
You know the feeling, right? If you follow the markets, you're constantly seeing these tech stocks with valuations that just seem to be in the stratosphere. It can be a really frustrating game, especially if you're an investor just looking for real, solid value in a market that feels, frankly, a little overheated.
So if not there, then where? Well, some of the smartest folks are turning their gaze from Silicon Valley to actual valleys and fields. The focus is shifting to agriculture, a sector that's built on, the most basic human need there is.
And that brings us right to the heart of this explainer, an analyst's 2026 investment playbook for a huge player in this space, Nutrien, ticker symbol NTR. So let's get right to it and break down their bottom line.
This quote right here, this is the whole idea in a nutshell. The need to feed a growing planet isn't just a trend, it's not a fad that's going to fade away. It is a permanent structural reality. And that simple fact is the bedrock of this entire investment case.
So here's the crucial shift in thinking that the analyst is pointing out. Nutrien isn't just a recovery play anymore, a stock that's just bouncing back from a low point. The argument now is that it's actually morphing into a steady compounder. Think of it as a business that can just consistently and reliably grow year in and year out.
Okay, so what does that actually look like in the real world? Well, the analyst lays out a pretty clear game plan. They suggest accumulating shares between 58 and 60 bucks, which they see as a zone where big institutional money likes to buy in. They're setting a short-term price target of $66 and a medium-term one of $72. And of course, the all-important safety net, a stop loss below 55 bucks. That's the point where you'd have to say, maybe this thesis needs another look.
But look, for any of those price targets to make sense, you gotta understand the engine that's driving the whole company. The analyst calls Nutrien's business model a powerful flywheel. So let's take a look at how this thing actually works.
This flywheel has two big connected parts. On one side, you've got the upstream business. This is their gigantic wholesale operation. I mean, these guys are the world's #1 producer of potash and a huge force in nitrogen and phosphate. When fertilizer prices are high, this side of the business is an absolute cash machine. Then on the other side, you have the downstream retail business. This is their incredible network of over 2,000 stores that sell everything a farmer needs, seeds, chemicals, services, directly to the end user.
So why is this two-part model so important? Well, because it creates this incredible competitive moat. Think about it. When the commodity markets get choppy and fertilizer prices dip, the big upstream business might slow down. But that's when the steady, predictable retail side kicks in, providing a stable flow of cash. This whole structure just smooths out the wild swings you'd normally expect from a pure commodity company, making the entire business way more resilient.
Okay, so we understand the company's internal engine. Now let's zoom out a bit, because this whole thesis isn't just about Nutrien's strength. It's also about what's happening in the broader market. And the analyst believes we are in what they call a Goldilocks setup.
What on earth is a Goldilocks setup for fertilizers? Well, it's that sweet spot. It's an environment where prices aren't so scorching hot that they destroy demand from farmers, but they're not so cold that they kill the profit margins for producers like Nutrien. Everything is just right.
And there are three big global forces creating this just right environment. First, the nitrogen market is pretty tight because of plant outages and project delays, which is helping keep prices firm. Second, the potash market has found its footing again, with huge buyers like Brazil and India coming back strong. And finally, with all the geopolitical instability out there, nations are laser-focused on food security, and you simply can't have that without a reliable supply of fertilizer.
All right, the story sounds really compelling, doesn't it? But you know what they say, talk is cheap. Do the numbers actually back it up? Let's dig into the hard data that supports this whole narrative.
And wow, the numbers really are compelling. Just look at this, a 42% jump in year-over-year adjusted EBITDA. That's a massive increase in the company's core profitability. And it's a super clear sign that they have some serious operational momentum right now.
And that's not all. On top of that growth, investors get a 3.6% dividend yield. The analyst has a great phrase for this. You get paid to wait. While you're holding the stock for that potential long-term growth, the company is literally paying you a steady stream of income.
And they're not just growing the top line, they're getting leaner and meaner. The company is on track to hit its $200 million cost savings target ahead of schedule. That kind of disciplined management flows directly to the bottom line.
Now let's put this all into perspective. Let's talk valuation.
This chart shows the price-to-earnings ratio, basically how much you're paying for $1 of a company's profit. Nutrien is trading around 17 times its earnings. Now compare that to the average tech stock, which is way up there, closer to 30. This really shows you the value proposition in a single picture. You're paying a much more reasonable price for a company with really solid fundamentals.
But of course, no investment is ever a sure thing. A credible analysis has to look at both sides of the coin. So what could go wrong here? What could derail this whole story? Let's take an honest look at the key risks.
The analyst points out 3 major threats to keep an eye on. First, a huge spike in natural gas prices could really squeeze their production costs. Second, bad weather, like a super wet spring in North America, could delay planting and hit the retail sales hard. And finally, a big geopolitical shift, like if sanctions on Belarus were suddenly lifted, could flood the market with cheap potash and just crush prices. These are the real risks to watch.
So there you have it. That's the playbook. And it all leads to this one really fascinating final question. In a volatile world that's always chasing the next digital frontier, could it be that the most powerful, most reliable growth is found not up in the cloud, but right here, in the ground beneath our feet? It's definitely something to think about.